The Realty Income Corporation, ticker symbol O, is one of the most popular real estate investment trusts you can buy. The stock is beloved by dividend investors. That's mainly because of its reliable monthly dividend. This is such a core part of O stock that it's become a marketing angle. In fact, they've trademarked and refer to themselves as the monthly dividend company. That dividend has a history of strong growth. Realty Income is a dividend aristocrat, meaning it has over 25 years of consecutive annual dividend growth. O stock typically raises their dividend more than once a year. In fact, their investor page states they have 103 consecutive quarterly increases. This stellar dividend has played a large role in the company's return for investors. Since its 1994 IPO, the stock has had a 14.2% compound annual total return. The dividend has a 4.4% compound annual growth rate in that time. But can the stock continue that strong performance? 2023 has been a bad year for Realty Income stock. Year to date, the price is down 23%. Much of this decline is over the past 2 months. The stock is down over 11% in the prior month. O stock now posts a 6.24% dividend yield. This is the highest yield since the 2020 stock market crash. So is this price decline a sign to stay away, or is it a great buying opportunity? In today's video, I'm going to do a full stock review of the Realty Income Corporation. This will include a deep dive into their business model, financials, and recent news. Finally, I will calculate a stock valuation and model out what an investment in O stock now could generate in future returns. Let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. Throughout, I'll be using the stock research tool I personally developed, which is available at dividenddata.com. Here you can do deep financial analysis on over 7,500 stocks, helping you find better investments. You can also track your portfolio with custom dividend-based analytics. Link in the description and pinned comment. As Warren Buffett says, you should never invest in a business you cannot understand. So let's take a deeper look into the company's history and business model. In 1969, William and Joan Clark founded Realty Income after acquiring a Taco Bell property directly from Taco Bell founder Glenn Bell. Their vision was to create an investment platform which could provide shareholders monthly dividends that increase over time. The Clarks took a unique approach, purchasing commercial real estate and leasing each property to well-qualified companies with a strong financial profile. They specialized in triple net lease properties. This is a lease agreement whereby the tenant promises to pay all the expenses on the property, including real estate taxes, building insurance, and maintenance. This is in addition to the typical cost of rent and utilities. The triple net lease model provided Realty Income a steady stream of monthly revenue for dividends and growth investments. In 1994, Realty Income began trading on the New York Stock Exchange under the ticker symbol O. This set the stage for even more substantial growth by providing the company an easy source to raise capital. Since going public, annual revenue has grown from $49 million to $3.34 billion as of 2022. So what does Realty Income's business look like today? The company has amassed over 13,100 properties as of Q2 2023. These properties are primarily in the US, with 88.3% of annualized rent being domestic and 11.7% international. The main international region is the United Kingdom, marking 10.5% of their annual rent. In the US, the top states are Texas at 10.1%, California at 5.6%, Florida at 5.3%, Illinois at 5.1%, Massachusetts at 4.8%, and Ohio at 4.1%. So what kind of properties are these? 82.5% of annualized rent comes from retail, 13.1% in industrial, 2.7% in in gaming, and 1.7% from other. Their top 10 industries are the following: convenience stores at 11.1%, grocery stores at 9.9%, dollar stores at 7.1%, home improvement at 5.9%, drugstores at 5.8%, quick service restaurants at 5.5%, casual dining restaurants at 4.8%, health and fitness at 4.2%, automotive services at 4%, and general merchandise at 3.7%. As I mentioned earlier, Realty Income focuses on working with high-quality tenants that have a strong financial profile. This means you will recognize many of their top clients. The top 3 clients are Dollar General, Walgreens, and Dollar Tree/Family Dollar. 2023 has been a bad year for these companies. Walgreens stock is down 40% year to date. They are closing 150 stores in the United States. I just made a video analyzing the financial troubles at Walgreens and exploring the possibility of them cutting their dividend. I would definitely watch that to learn more about Realty Income's top client and another dividend aristocrat company. Dollar General stock is down 57% year to date. Dollar Tree stock is down 26% year to date. I can't help but wonder whether the negative sentiment around Realty Income's top clients is a factor in their own 2023 stock price decline. But how much do these 3 clients really impact their business? Collectively, they make up 10.9% of annualized rent. In terms of store closures, these are not very impactful. For example, Walgreens has 8,689 total stores and is closing 150 of their worst performing locations. I don't even know if Realty Income actually owns any of these locations closing. Overall, Realty Income has 99% portfolio occupancy as of Q2 2023, so it seems like it's having next to no impact. We need to remember that these are still massively successful, multi-billion-dollar companies. They are high-quality tenants. The other top clients are 7-Eleven, EG Group, Wynn Resorts, FedEx, B&Q, Sainsbury's, LA Fitness, BJ's Wholesale Club, Lifestyle Fitness, CVS, Walmart, Sam's Club, Tractor Supply Company, Tesco, AMC Theaters, Red Lobster, Regal, and Lowe's. Nearly all of these are multi-billion-dollar companies who would be reliable tenants and likely expand over time. Realty Income's management specifically tries to get clients who are insulated from changes in consumer behavior. They identify these qualities as businesses who are non-discretionary, low price point, service-oriented, or non-retail. They specifically try to avoid industries with a history of bankruptcies so they can reduce turnover. According to their research, 130 of 176 U.S. retailer bankruptcies since 2018 are lacking at least one of these characteristics. Apparel and casual dining are the most likely to have bankruptcies. With a 99% current portfolio occupancy, the company is operating very well. In fact, their occupancy rate has never been below 96%. This is well above the industry rate. The core business of Realty Income works and works well. But how is Realty Income Corporation planning to grow into the future? The company states that the global net lease addressable market is $12 trillion. By that measure, there is a lot of room to expand. In fact, in 2022, they sourced $95 billion in potential acquisition opportunities. Over the past few years, the company has gotten far more aggressive with acquisitions. Some would argue that they are moving outside of their core competency, but we'll discuss that more later. In 2021, they acquired VEREIT in an all-stock deal. The combined entity had a new ownership structure where 70% of the ownership went to O-stock shareholders and 30% to VEREIT shareholders. They also spun off the office assets of both companies into a new stock with the ticker symbol ONL. That spinoff was a great move as the office market is doing terrible. This transaction helped significantly grow and diversify the business. For context, this grew quarterly revenue from Q2 2021 $464 million pre-transaction to $810 million Q2 2022 post-transaction. With free cash flow, it went from $314 million to $743 million. So the business has become far more profitable. The stock must have gone up, right? Well, not really. In reality, the shares outstanding increased dramatically from the deal, diluting the shareholder. So even though the business grew, your percentage of ownership declined. Free cash flow per share only slightly increased in this time. This is why it's important to look at things on a per share basis, which I show on dividenddata.com. Don't worry, the dilution is not over. Realty Income has 2 more major deals to discuss. However, these next ones will start an expansion outside of their usual client reliant industries. In 2022, the company acquired the Encore Boston Harbor Resort and Casino. On the surface level, this seems like a high-quality property with room for expansion. The deal was for $1.7 billion at a 5.9% cash cap rate. The transaction is consummated with a 30-year triple net lease with favorable annual escalators. This puts them in partnership with Wynn Resorts, which is a high-quality multi-billion-dollar company themselves. This marks a new market for Realty Income to explore. They were not done. In August 2023, Realty Income announced a deal to acquire a 21.9% ownership stake in the Bellagio of Las Vegas from the Blackstone Real Estate Income Trust. This is a $950 million investment valuing the property at $5.1 billion. $650 million of that investment was used to acquire a yield-bearing preferred equity interest in the joint venture. As the monthly dividend company, it makes sense that they would want to get some cash flow out of this minority investment. The Bellagio is an incredibly high-quality property in prime location on the Las Vegas Strip. It follows the triple net lease strategy and puts them in partnership with a financially strong client in MGM Resorts. These acquisitions are funded by raising capital through issuing more shares, diluting existing shareholders. On top of this, they'll use debt, so it remains to be seen whether or not they increase shareholder value. Now let's look at Realty Income stock from the perspective of a long-term dividend investor. To do so, I'll be using my stock research tool available at dividenddata.com. Here you have the data to properly analyze the financials of over 7,500 stocks. There is a 14-day free trial, so try it out and follow along with me as I analyze O stock. The Realty Income Corporation, ticker symbol O, has a current stock price of $49.27. With 708 million shares outstanding, the market cap is $34.91 billion. The forward-looking annual dividend is $3.07 with a dividend yield of 6.24%. The stock price has seen a massive decline since the fall of 2022. This price is the lowest since the 2020 pandemic crash among REITs. That may signal a great time to buy, especially if future dividend growth continues. Revenue per share is growing at a 4.32% 10-year compound annual growth rate. Free cash flow per share is growing at a 5.48% 10-year CAGR. 2022 annual free cash flow per share was $4.19. This means the stock is trading at 11.7 times free cash flow based on the current stock price. The company has rapidly growing assets with all these acquisitions. This has caused a significant increase in shareholder equity. However, debt has grown significantly while the company's cash position remains low. As a result, net debt has grown to $20 billion. That said, the company has strong cash flows and the ability to raise cash to cover this debt. Now let's get to the reason why all of us are here, the dividend. Realty Income pays a monthly dividend which has grown for over 25 years. The 10-year CAGR of the dividend growth rate is 3.8%. Typically, the company will increase the dividend every quarter. The most recent increase is 0.39% and the prior was 2.41%. After the VEREIT acquisition, they increased the dividend by 7.51%. So is this dividend payment sustainable? The dividend payout ratio based on free cash flow is 70% as of 2022. For real estate investment trusts, this is a pretty low payout ratio. I would say that Realty Income's dividend is very safe. However, that may not be apparent if you look at payout ratio based on net income. This is the default option on many investment research sites, but it is not ideal. That shows that the payout ratio is well over 200%. From first glance, that's not sustainable. The problem though is the metric of net income itself. Net income uses GAAP accounting and takes into account many non-cash expenses like on-paper investment losses or depreciation. This obscures many stocks, but especially REITs. Real estate is constantly facing depreciation for tax purposes, driving down the net income metric. It becomes a useless stat in terms of measuring the cash generation of a company, which is ultimately where the dividend comes from. That is why you need to look at payout ratio based on free cash flow, hence why I created this custom metric on my website. This, ladies and gentlemen, is one of the many reasons why you want to be using dividenddata.com. The monthly dividend is going to play a major factor in Realty Income's total return for shareholders. However, you need to keep in mind that you will be constantly diluted. This is the double-edged sword of high dividend REITs. They pay most of the cash earned to shareholders. This means they don't keep large cash on hand. They need to constantly issue new shares or use leverage in order to fund large acquisitions. projections. It's worked for Realty Income over the long term, but they have been very aggressive with this in recent years. I can't help but think that is one of the main factors why the stock is underperforming. There are also lots of predictions of doom and gloom around commercial real estate, but a lot of that does not specifically impact their business model. I think Realty Income presents a good value in today's market for the dividend investor. Let's do a dividend discount model valuation, since we will be mainly valuing this stock based on the dividends it provides. This calculator is available on my website dividenddata.com. A DDM values the company based on the sum of all future dividend payments discounted back by a provided discount rate. I entered the current share price, annual dividend, dividend growth rate, and a discount rate of 10%. This is basically setting your expectation at a 10% annual return. For the dividend growth rate, I used the 10-year CAGR of 3.8%, which I think is fair to assume. This calculates a present value of $48.57 for Realty Income stock. That means it is 1.4% overvalued according to this estimate. However, that is very close to intrinsic value. If you've been targeting O stock, then this may be a really solid time to start buying. What would a one-time $1,000 investment in O stock right now actually look like? Well, I have a future projection tool built out on dividenddata.com which aims to answer this exact question. It measures the impact of dividend reinvestment over the long term. First, we enter the current stock data. I used a 3.8% dividend CAGR and 5% stock price CAGR. I think these are both realistic and on the conservative end. We have a one-time $1,000 investment with a monthly payment and dividend reinvestment selected. By the end of 10 years, the total value is estimated to be $2,800 with $149 in annual dividends. That gives it a 14.96% dividend yield on cost. The power of dividend reinvestment is immense here. This compounding is best shown over the long term. Over 35 years, the total value would be $32,000 with $1,221 in annual dividends. That is a 122% yield on your initial cost. This is what we call the dividend snowball effect at work. The constant stream of dividend reinvestment increases your share count, growing your future dividend income. This combined with dividend raises creates a strong compounding effect. What would it look like if you invested $1,000 every month in O stock? By the end of 35 years, you would have a total value of $3.5 million. This is with $420,000 invested. The annual dividends would be $135,860, giving it a 32.35% yield on cost. That's a pretty great result for $1,000 a month, which is totally possible for those who choose to prioritize it. That said, it's important to do your own research before making any investment decisions. Currently, I do not own any O stock. It was in my portfolio from 2020 to 2022. However, I found better opportunities at the time as I bought large amounts of Microsoft stock in the fall of 2022. Also, it's important to mention that in the US, dividends from REITs are taxed as ordinary income. This means you don't get the lower rate of qualified dividends. That would not be a problem in a Roth IRA though. Overall, I definitely think Realty Income is the best monthly dividend stock you can buy right now. I may even consider adding it back into my portfolio. Make sure you leave a like, share, and subscribe to the channel if this video provides value. If you want to use the research tool I've been showing throughout the video, then sign up at dividenddata.com. If the software helps you identify just one slightly better stock, then it pays for itself. Thanks for watching.